So you're interested in investing in the stock market, but you don't know where to start. I would like to preface this video by explaining that for the first time in humanity, the average person is capable of making a lot of money on the stock market. If you look back at the 1970s when a lot of the financial regulations were created, they made it so that you had to basically work in the financial industry to have the certifications and understanding of the way that things worked to actually trade on the stock market. And this was during the analog period before the digital age when everything was done on paper. What we have in 2018 is that all of you are capable of buying stocks today, one stock at a time with no trade fees. The best tool that I know of for this is called Robinhood. I'll put a link in the description below for you guys to download it. It's an awesome tool. You can buy cryptocurrencies on it. You can see financial data really quickly off your phone. And it's an interesting app in that in the past, if you were to invest $100, you would have had to pay a $10 fee. Now you can buy one $5 share at a time and there's no penalties whatsoever. And so that's what's really interesting about what we have today as investors is that anyone's capable of getting into it. So just before I explain the strategy aspect of this video, I think I'd like to also give you guys a brief understanding of a few of the financial metrics that people use to track everything. These are the things that you'll need to understand to have a conversation with really anyone about your investments. So the first one is called market cap, and this is also market capitalization. This is the total value of the company's stock. This is a very important indication of the size of the operation that you are investing in, and also is a precursor to how much risk you are going to involve yourself in. Technically, smaller companies seem to have more risk over time, whereas larger, more established companies are less likely to go to $0. So the next factor that you should understand is the beta, and it is essentially the market volatility. For those of you that don't know what volatility means, it's essentially the extent to which it continues to change. So if you look at a stock and it's very predictable, that is something that does not have a lot of volatility. But if it goes up very quickly and then goes down very quickly and then goes back up, that has higher volatility. And so with beta, we measure the average market volatility at 1. Anything below that is considered less volatile. So your blue chip, like your larger companies, like your IBM, your Facebook, those types of companies, they tend to have a lower beta because they are less volatile than the smaller penny stocks that you might find with an incredibly high beta. So the next factor that I'd like to talk about is the price to earnings ratio. Essentially what this is you take the market price of the stock and then you divide it by the earnings. And so this is something that is used to articulate how much a company is worth in terms of their revenue as a business and then in terms of the value that they are perceived as in the stock market. And so something that you'll find is that there are companies that aren't even making that much money, but their stock is huge, and the opposite happens. There's a lot of factors that go into what determine that, but knowing what the price-earnings ratio is gives you a better perspective. And so the next factor I'd like you to understand is dividends. And so dividends are essentially money that are regularly paid to shareholders. What this does is if a company has high dividends, if they're paying their shareholders a lot of money frequently outside of the price of the stock, it encourages people to buy it, which causes the price of the stock to go up. And so it's a win-win in that the people who are buying the stock, they're getting money regularly from the company, and the company's getting more people to buy shares to finance their projects. And then the last factor that I would like for you to understand before I get into a basic strategy is the volume. The volume is the number of shares at that current moment that are on the market. And so if you were to multiply the outstanding number of shares with the price of stock, you get the market capitalization. So the total value of a company is derived from the price of its stock and multiplied by the outstanding shares. And so I'd like to let all of you know that I've left all of these definitions in the description below. So if you want to reference that before going forward, that would work. But all of this information for each individual stock that you'll be looking at is available on Yahoo Finance. And for this example, I think that Yahoo Finance will be what you guys should use to gauge basic metrics about stocks, companies, and how they're doing. So the easiest strategy that I can teach you is based off looking at the 1-year estimate. And so a description of what the 1-year estimate is, basically the people who do this for their career, the people who say, I believe that this company will be this large at this time, Yahoo Finance is collecting a lot of those, a lot of predictions about where a stock will be in 1 year, and compiling them all in a list for you. And so all you have to do is look at the 1-year target estimate of a company. Let's say you've got two companies. One company is estimated to go from $20 to $25. And that means that the current price of the stock is $20, the 1-year estimate is $25. And then we look at another example of a stock that's at $100 and is going to $105. So the $100 stock is only going to increase by 5%. But the $20 stock is going to increase by 20%. And so when we think of it in terms like this, it makes it a lot more apparent as to how you want to invest in stocks that are going to increase a lot as a percentage basis rather than a dollar basis. And so this does not necessarily mean that you only invest in smaller stocks. More so what it means is that you want to look at things very proportionally. And so you can find these numbers straight off of Yahoo Finance. And ideally, what you will want in a stock that you are buying is that the lowest prediction by the people who are creating these price targets is higher than the price of your stock. So they will have an average and a lower and a higher range. So the lower range means the person who predicted it would be the lowest of all of the analysts for the one stock. And then the highest is the person who says it's going to be the highest. Average is obviously the average. You're going to want to make sure that the average prediction of where the stock will be in the next year is higher than the price of the stock. And so ideally what you'll look for is the stock with the highest prediction in 1 year on a percentage basis. If you're looking for a way to calculate this on paper, it's the average price target divided by the stock price. That's it. So let's say that they predict that it's going to be at $100 and it's $50 now. That means that they're predicting that it will increase by 100% or 200% gain. And so that's how I have used the expected 1-year return to make a lot of money on the stock market. I've used it artificially with fake money so that I could do it on a macro level and test a bunch of different stocks and keep them on my watch list and see what works and see what doesn't. And I've done it on a micro level with my own money, and I found that the Standard & Poor's, which is an index to basically couple together 500 companies that are a representation of how good the market's doing. It goes up about 10% a year. I think that you will find that if you use the 1-year target strategy, not only will you beat the 10%, but it's possible that you might even start making a lot more money than that. And so I recommend that you look into this strategy. In future videos, I'll be explaining more. If there's anything in particular that you guys want me to cover, leave it in the comments below. But other than that, thank you guys very much for your time. I want to leave you with saying that all of you are capable of making money on the stock market, and it is never too late to start. Thank you for your time.